with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's going crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, December 5th, 2025. It's beginning to look a lot like Christmas. A little snow on the ground out here in the Mid-Atlantic. Some big shout-outs this week. Jody, Bob, Jerry, Dave. Looking retired there, Dave. And a big shout-out to Zach. Great time catching up with you this week, Zach. Hey, let's go ahead and jump into the numbers. Let me tell you what's going on. Taking a look at the markets. Look, things kind of pushed a little higher this week. I think the overall thing that allowed the market to push higher, is pushing the market higher, is a bit of a resolve that the market expects the Fed to cut rates next week. We'll talk more about it in a moment, but the Dow Jones was up 0.5%, S&P 500 up 0.3%, NASDAQ Composite up 0.9%, and the Russell Small Caps Index up 0.8%. So everything pushing a little bit higher this week. Looking at the volatility index, it was lower, down 5.7%. Down to a 15.4, so slipping down into that complacent territory. But I'll tell you this, the S&P 500 did not hit an all-time high yet. It has not gone back to all-time highs. It has failed to do so at this point in time, and things are looking stretched. This volatility index could get shaken up. We'll talk more about that in a moment, too. Looking at long-term bonds as measured by the TLT, down 2.2% on the week. So bond values dropping. Interest rates going higher. What's causing that? We didn't have any major inflation data this week. We had a PCE number that came out, personal consumption expenditures. It's the number one number that the Fed looks at when it comes to inflation. But it's an old number. It was in September. It was largely in line. No big surprises. There was some talk this week about the next Fed chair. Trump administration kind of indicating there for a while that Kevin Hassett may have the job. And there's some talk in the circles of money management, of folks trying to get ahead of a White House-friendly Fed chief, one that's going to do what the White House wants them to do, which would mean cut interest rates, even in the face of inflation maybe. But I think that's premature to start talking like that. And once a person gets a job, we'll have to see actually how they act. But nonetheless, long-term bonds down 2.2, interest rates higher, not a whole lot of indication as to why. And it kind of has my attention. It's something that I'm watching closely because the bond market is usually considered to be the smart money, and the bond market is acting a little wonky at the moment. How about some other things? How about the sectors? How did they do this week? Look, all the defensive areas really came off the boil this week. They kind of cooled off as money went into more of the growth areas of the market. So we saw staples down 1.1%. We saw healthcare down 2.7%. Real estate down 1.6%. And then utilities, a little bit of a double whammy there. Utilities are looked at as defensive, so they were down because money came out of the defensive areas. And then utilities are also looked at as a competitor to bonds. So when rates go higher, utilities tend not to do so well. One, because they're competition to bonds. And when bonds look more attractive, people buy the bonds rather than the utilities. And two, utilities have a lot of debt. So when rates go higher, they pay more for their debt service. So a couple of things there pushing utilities down 4.4% on the week. So they took a bit of a hit. Gold and silver, gold down 0.3%. Gold and silver, silver and gold. Rudolph, huh? Gold down 0.3% and silver up 3.4%. So high-ho silver ripping higher, up 101% on the year. What about the rest of the market? How did things look this week? Well, some earnings were driving the market this week. We had some good earnings numbers. We got Marvell Technologies on our aggressive model. It's a chip-making company, and they reported a great quarter this week. Stock was up just under 12% on the week, and We bought that one back in March of 2023 for $39 in our aggressive model, and it finished the week at 96, up about 11.9% on the week after a really strong earnings report. And then how about Ulta Beauty? How about a shout out to Farah Dill, the daughter of our Chief Operating Officer, Carol. About a year and a half or so ago, I was doing a deep dive on makeup retailers. I wanted to buy something in that space, doing some anecdotal homework, asking around about preferences. And it was Carol Dill's daughter, Farah, that pounded the table that I needed to buy Ulta Beauty. It was a no-brainer. It was a must-buy. So I did all my due diligence, of course, and though it was a little expensive at the time, we waited. And then March of this year, I guess March is just a good time to buy stocks. We bought Marvell March of 23. We bought Ulta Beauty March of this year for $344, and it closed the week at $600, up 11.6% on the week with a great earnings report there as well. So some strong earnings. Things been looking pretty good on that front. And then economic data. The economic data has been all over the place. But as I mentioned a moment ago, the one thing about it is it hasn't upset the idea that the Fed should cut next week. Okay. We talked about this before the Fed made the first rate cut. What I mentioned to you was that normally, if they're going to cut once, they're thinking three. They're thinking three cuts if they go to cut one time. And they made that cut, and here we are approaching this third one, and they really put it in doubt after the last meeting. You know, Fed Chair Jay Powell took the notion that this next rate cut was locked in, took it right off the table. And here in the last couple of weeks, we've been getting some data. Nothing's come out that just suggests that the Fed can't cut. We had that inflation number, the PCE, personal consumption expenditures, which was largely in line. Market seemed to be okay with that. It's dated, it's from September, but it was still largely in line. And then on top of that, the jobs numbers have been sloppy. ADP, which is a private payroll company, showed a big drop in jobs and jobs lost, actually. But then, on the other hand, the government data, initial claims dropped big time, and the continuing claims have dropped sharply. So those are positives. These are going way back to like numbers from 2022 and 23. So that looks really, really good. Services number was strong. Manufacturing was weak, but that's been kind of consistent as of late. And then the consumer, look, the consumer's still spending. I mean, right now it's looking that through Cyber Monday, U.S. shoppers are up 8.8% in sales from this time last year. And everyone's been saying the consumer's stretched. We're seeing that in some of the data with credit card defaults and auto loan defaults, mortgage defaults even. But look, they continue to spend. I guess they're just going to spend until they break, you know? I mean, kind of reminds me of the Stretch Armstrong that I had when I was a kid. You know, you could pull that thing to death. You couldn't break it. But if you left it out on your bedspread in the sun while you went to school, it would melt and you'd have red goo all over everything. Hopefully that doesn't happen with the consumer. I digress. The bottom line is the economic data has been mixed, but it hasn't upset the narrative that the Fed can cut rates. And I think the market is absolutely expecting that next week. I think we're at a 90% expectation that's going to happen. And I have come around to believe that they probably will cut next week at this point in time. But it'll be interesting to see what they say. All right, what will they say moving forward? That could upset the market a little bit. And when you look at where the market sits right now, look, the S&P oscillator, I've talked about that before. It's a really strong indicator, and it flashed a 5.8% today. When it gets over 5, watch out. It usually means the market's going to consolidate or drift a little bit lower, and we're at a 5.8. We've got the DeMark indicators. I talk about that quite often, another technical indicator that I follow closely, and they are showing the market is stretched on the daily numbers and on the weekly numbers. And finally, there's just the overall sentiment of my industry. Every single person that has a mouth and breathes and works in my industry is expecting the market to rip higher into the end of the year. Everybody. I've not heard anybody to the contrary. And you know what I've said, when there's consensus, watch out, right? When everybody gets on the same side of the boat, you better start getting to the other side. Look, they all thought we were going to have a rotten October, and that didn't happen. They all thought we were heading into a horrific recession. The market was going much lower back in April. That didn't happen. So right now, the whole crowd's expecting everything to rip higher into year end. It very well might. You know, there's a lot of things that say it should. But again, when there's a lot of agreement, I get a little concerned. And there's a lot of agreement out there right now. So where we sit is great. We're going to sit back, see how things unfold. The Fed will meet next week. They'll speak. That'll move things around. We're going to have some earnings next week that are really not that important, but we're going to start to capture some November numbers. My friend Nick Rake over there at Earnings Scout has got a great system over there for tracking earnings expectations and the changes in the deltas on earnings. He will be all over that, and we'll definitely be getting some information on him on how that's looking. So we're just going to kind of hang back, let things unfold. We got a little bit of cash on hand to do some buying if opportunities arise. But if it wants to rip higher, great, go for it. Go on, right? And if it wants to fall, it's okay. We'll do some buying. We'll pick up some Christmas bargains. So we're in good shape. So between now and next meeting, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's retire a little early, take that big trip, buy that classic car. You know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.